Hi there, Marcus Brantley, your host of Boardroom Minutes. Welcome back to my channel. We have an interesting topic on today, and it is the NCUA proposes change to the director training rule. What credit union boards must know. Again, welcome back to Boardroom Minutes, which is your premier channel for clear, concise insights into the issues that shape today's boardrooms at for-profit corporations, nonprofit organizations, and religious institutions like churches. Again, welcome back. And if you haven't subscribed to my channel on YouTube, why don't you do that by hitting the subscribe button? And then why don't you also like this episode? Or if you desire to, you can wait until after the episode airs. And if it was beneficial to you, you can like it at that point. All right, let's do a dive into our topic today, which is the NCUA proposes change to the director training rule. What credit union boards must know. Now, let me just say at the outset, this is credit union specific. However, I think it will provide relevance to other types of organizations, even banks or nonprofit organizations or religious institutions, regardless of the space that you're in. The point is that as a director, you need to be up to date on relevant issues that impact your organization. So today we're discussing an issue that impacts credit union board members, but there may be a topic that comes up, a regulatory change that could very well impact your organization, depending on what sector of the economy you are in. But today, there is a current proposed change by the NCUA, and that's the acronym for the National Credit Union Administration. NCUA. Now, they have proposed a regulatory change that every credit union board should pay attention to. And what this has to do is the requirement for credit unions to make sure that their board receives adequate financial literacy training. And more specifically, this requirement is under the regulation entitled 12 CFR 701 4B3. And that requires all newly appointed other credit union directors. They are grandfathered, but they still are responsible for having a financial background or being financial literate, so that they can understand the business of the credit union. So this new requirement is really, it was implemented or proposed, I should say, for newly appointed credit union directors, and that they were required to obtain expertise in finance and accounting within 6 months of their election. So what occurred, is that the NCUA, which is the regulator for credit unions, they have a board, and at this stage, they only have one member because the other two members were dismissed, and then there was no appointments, and now the board only has one board member for the regulatory body. Now, just to give you a brief background quickly on the regulator, credit unions are regulated by the NCUA. Banks are regulated by the FDIC. They also have the control of the currency for some of the institutions. So each particular financial institution has their own regulator. And here we have credit unions that are being regulated by the NCUA. Now, if this regulation were to be adopted, this would pretty much eliminate a long-standing post-election training requirement for volunteer members. So again, if this regulatory change, not the regulation itself, but the change to the proposed regulation. If it's adopted, it would eliminate that requirement that newly appointed directors, or newly elected directors, I should say, would not be required to obtain board financial training. So, what does this mean for your board? Is this providing you relief, or is it facilitating risk? Well, why don't we take a look at it? And the current rule or regulation, as I mentioned, it requires these newly elected directors, and they could be appointed too, but for the most part, elected directors, and they are required to either possess financial and accounting expertise, and they must obtain it within 6 months of joining the board. And be it as it may, the requirement was designed to ensure that directors that are overseeing, the funds of the membership, have a basic understanding of financial statements and also risk. You have to have some familiarity of financial statements, and also know the perils of risk. And it's your job as a director to make sure risk is mitigated. So, by this proposed requirement, the intention was pretty clear, and that is to protect the safety and soundness of the credit union. Now, this rule in its intent also was about making sure directors are competent. And I believe in that. Directors ought to be competent because they are part of the governance structure of the institution. And in some cases, we're talking multi-billion dollar financial institutions, and you have the hard earned funds that are deposited in these institutions. Some are life savings. And there's a onus upon the directors to make sure that they are having the general oversight of those assets for the membership. So, this proposed change, it would eliminate the mandatory 6-month training requirement. There would be no regulatory obligation to obtain accounting expertise. And then that would, in a way, reduce the compliance burden on volunteer boards, because most directors for credit unions are volunteers. Now, there are some that do receive compensation. You have quite a bit of state chartered institutions that receive compensation, their directors, some on the federal that are federally chartered, and it's a two-tiered system. There is also another tier, which are the corporate credit unions. That's for another day. But you have state chartered, federally chartered institutions, and they have different requirements. And state chartered credit unions, their regulation are more laxed when it comes to compensation for directors. But the federal rules do allow at least one director on a federally chartered board to be compensated, and that's typically someone that has an accounting background. And that is to sort of make things more amenable to smaller boards who you may not have the expertise, but you would have one person that happens to be an accountant, and they would be compensated because they're doing the rote work. They're doing the daily work of the credit union, and therefore the regulation would allow that. So the key takeaway here for this change is that it shifts responsibility from regulation to governance discretion, right? So rather than having the directors required, it then allows the institution at its own discretion as having a self-governing structure. It allows the credit union to then make sure on its own on its own cognizance, if you will, that their directors are properly changed. So why don't we take a look at some of the benefits of this proposed rule being eliminated? And as I mentioned, it would reduce a compliance burden because some financial institutions, credit unions that is, may not have the wherewithal to send their directors for training. And this has to be done within 6 months. And because volunteer directors they serve without compensation, this may be a burden upon them if they're responsible to come out of pocket. Or again, you have credit unions of modest means. They may not have the ability to pay for their directors to receive training at a cost. Then also, aside from reducing that compliance burden, this will provide greater flexibility. Why? Because it won't be a one size fit all solution. In other words, credit unions, again, in their self governance, can tailor the training specifically to the size and the complexity of their institution. It doesn't make sense for a director to receive the training of a credit union board that is a multi-billion in assets credit union, and they're only, let's say, 25 million in assets. Although the principles are the same with regard to financial statements, the complexity is different. So it gives some flexibility to self-governance if this proposed change is passed. And then it allows for a broader board diversity. And some qualified community leaders may have avoided board service because of the perceived technical requirements. So now you have potential directors who would have been interested, but because of this requirement was within 6 months, it may cause excellent potential directors to not want to join or be elected or appointed to a board. So those are some of the upsides with regard to this proposed change, eliminating the requirement. But then there's also the potential risks. With every benefit, there's a downside. There's a pro and a con. So let's look at a couple, maybe two or three risks, and that has to do with financial oversight gaps. You want your directors to be trained in financial matters. They have the general oversight. They just can't rely on the management to spoon feed them, if you will. They have to be able to look, and not only look, but study and review the financial statements, those reports that are before them. So if a director can't interpret a financial statement, then they may struggle to fulfill their fiduciary duty. And as we've talked in previous episodes, you are fiduciaries as a director, and you have to exercise the duty of care, which involves understanding financials. And then, again, as I mentioned, you don't always want to rely on management, although some laws in some states do allow directors to rely on the expertise of executive management, but you don't want to be gullible. You still, there's a saying, trust but verify, because the bottom line is the buck stops with the board. They are responsible for the member funds. So you don't want to have an increased reliance on management. And then also a risk is, again, reputation and risk exposure. By eliminating this, the fiduciary responsibility, there may be a breach, and as a result, it may result in the institution having reputation risk and other risk exposures. So the duty of care still remains, and if they are not financially competent, then that risk increases. So, what should smart boards do, whether this proposed change happens or not? You are still, again, responsible. And what boards should do is, uh, or rather are, to maintain a structured orientation program. Soon as you are elected, there should be a board orientation to familiarize the director not just with financial statements, but the culture of the credit union, the membership. Who are you serving? An orientation is important regardless of the regulatory requirement. And then the institution should have financial literacy workshops that directors should be involved in. There needs to be an effort to learn about the financial uh, operations of the credit union. And then there should be annual continuing education. And there are organizations, trade organizations, America's credit unions, Qs, there are various AACUC, there are various trade organizations that provide financial literacy and financial continuing education. And then you also should ensure that there's at least one financial expert that's on your board. Now, everybody shouldn't be a CPA because you don't want a monolith. You want to have a diversity of ideas. You want to have an exchange of ideas. And a CPA may not see the same perspective from a person who's a school teacher if you have a membership of teachers. But you want to have at least one financial expert on your board. And then you need to leverage the reports that are issued by your supervisory committees. Now, for other entities, that may be your audit committee, like banks have audit committees, but credit unions, you have supervisory committees, and you need to leverage that because those reports and audits are very, very important. So a proactive board will treat training as a governance strength, not a regulatory burden. But at the same time, you have to allow credit unions to self-govern. So one of the larger questions that is raised by this proposal is should competence be mandated? Should financial literacy be mandated? That's the big question. Or is it about cultivating being cultivated by leadership culture? In other words, allow for self-governance, allow the institution to make sure their members are trained. Because the best credit unions, in essence, will not lower their standards simply because the rule changes. And as I mentioned earlier, regardless of whether this passes or doesn't, there should still be a high standard for directors. And as we conclude this episode, if this change becomes final, yes, your board will have more flexibility. But because you have more flexibility, it means that it's going to require more board director maturity. Training isn't just about checking boxes. It's about protecting the members' funds and their trust. And I think we're going to end it right there. Thank you for tuning in. I hope this episode was beneficial and relevant. This is a current event regarding the NCUA's proposed change to the director training rule and what credit union boards must know. All right, this is Marcus Brantley. Hope you enjoyed it. Why don't you hit that like button if you did? And if you haven't subscribed, why don't you subscribe as well? Until next time, again, Marcus Brantley, your host for Boardroom Minutes. Thank you and see you next week.